get started, and this seems to be the antithesis of venture. We're going to discuss some private credit. And I appreciate Trang puts this right before lunchtime, too. So we'll try not to get too nuanced and go into structured credit or the nuances unless asked. But with that, I'd like to introduce our panelists. Now, I'm joined here by three individuals. So all the way down, we have David Barcus from Denison, followed by Eric Kirsch in the center, well, quasi-center over there. And then also have Rodney Overcash from the Cargill Philanthropies. So with that, I would appreciate if we can maybe go down the aisle and maybe starting with you, David, just to talk a little bit about your organization and your responsibilities, and then we'll launch into some questions.
Okay, great. I'm David Barcus. I'm coming from Denison University, a liberal arts college in Granville, Ohio. There's about 2,100 undergrad students there, very impressive kids, young adults, I should say. The endowment, we have about $800 million under management, funding roughly 30% of the university's operating budget. I'm manager of investments there. I'm a generalist covering all asset classes. Been at Denison for about 6 years. Prior to that, I was in Chicago working for Credit Agricole's Fund of Hedge Fund Group. So my experience might be a little bit built up in the liquid alt space, but have definitely evolved at Denison to cover a little bit of everything. I don't know if we're going in order from assets under management, but we should have thought about our seating here.
Great, Eric.
Sure, thank you. Good afternoon. I'm Eric Kirsch, the Chief Investment Officer of Aflac, the insurance company. I'm sure you all know the duck. I've noticed in the last 24 hours I'm unique in this crowd because most of you are endowments, foundations, maybe pensions. So I run the general account for an insurance company. In terms of Aflac, a fact that I would guess most of you don't know, 85% of Aflac's revenues, profits, and the assets I run come out of Aflac Japan. So Aflac is actually much bigger in Japan than it is in the US. Nevertheless, in my responsibilities of running that 110 billion, of which 85% is for Japan, all those liabilities are in yen, so I have to focus on yen from an ALM standpoint, but we view the portfolio as global. Also, as an insurance company, highly regulated, you're managing policyholder money, so we're predominantly fixed income with perhaps a 3 to 5% bucket of what we call growth assets, private equity, real estate, could be hedge funds, et cetera. But within the fixed income bucket, a high dependency on credit assets, credit and structure. As an insurance company, we don't want to earn the risk-free return. We want to earn some spread and be able to earn that well over time. So as an investor, we're not total return oriented. It's more ALM matching, economic capital, and being able to ensure that we've got money good as opposed to what spreads are doing on assets on any particular day.
I'm Rodney Overcash from Margaret Cargill Philanthropies. I joined in 2012. We're a fairly new organization, new foundation. We're actually, Philanthropies is an umbrella group that oversees 2 foundations, Anne Ray Foundation and the Margaret A. Cargill Foundation, in total assets of about $7 billion. I manage our credit strategies, and that's about 30% of the portfolio, and that's running everything from long-only traditional fixed income that includes rates and corporate credit and emerging market debt and structured credit, and as well as long-short credit hedge funds down to private credit distressed lending as well. So the mission of our philanthropies is very many different ones, but also very specific in environment, focus on conservation and biodiversity. We focus on disaster relief and recovery, as well as animal welfare, teachers, quality of life, quite a few different things.
Excellent, thank you. So for the first question, I'm just going to jump right into it and talk about the growth in the private debt space. With that, maybe Eric, you can kick this off, just because your industry's been investing in credit for a long time. I think it's a little bit newer that we're having foundations, endowments, and others spending so much time in some of this private debt. I'd be curious to hear your thoughts on how you see the landscape, how it was maybe a decade ago, to who you're sitting next to as investors right
Sure.
now, and do you feel that it may be getting a little extended now that you're 10 years into the market?
Sure. Well, I'll come at it from the lens of an insurance company. For insurance companies, private debt is not new. Been doing them for decades. More traditionally in the private placement market. But insurance companies like Prudential, MetLife, Aflac to a certain extent, have credit teams that are underwriting the individual credits. And typically in the traditional private placement market, they're longer duration, 10, 20 years. So for insurers, good credit underwriting, going through cycles is nothing new and taking that risk. But again, more of a focus on longer-term liabilities, can ride out storms, if you will, making sure you have a good risk-adjusted return, because as you go through the bad part of the credit cycle, no doubt you'll have some credits that don't do well. I think the newer phenomena is in middle market lending, private lending, particularly for some insurers like us. But as you all know, in the private lending market, it was mostly a bank market 10 years ago. But with the advent of Dodd-Frank, they no longer could afford to be in that market. But all these companies that you hear of, Ares and Terry's and a bunch of others, needed more permanent sources of capital in order to do their business of making loans to these companies. So what we found when we got involved in this about 2 or 3 years ago, those companies viewed insurers as natural sources of capital. Why? We're used to credit, so we spoke the language. 2, we could be long-term investors. We're not in and out. We don't desire to be in and out of things. And 3, for them, knowing you would have a pool of capital that they can rely on, because typically these loans might be 3 to 5 years, well, you need to always have a constant source of capital to underwrite more loans. So there has been insurance companies at least jumping into this, but it is spreading out to other investor types, clearly. And I would say different flavors of the strategy for different investor types. So how an endowment or a foundation might look at their return profile and objectives probably are slightly different than how we would at Aflac.
So I'd be curious on really David and Rodney, over the past 5 years, when you look at your portfolio, have you increased that private debt? And if you have increased it, what have you taken down to make room for that private debt?
Maybe Rodney, I'll take the first stab. So, the way we've approached the space, and originally you talked a little bit about saturation as the market saturated, the amount of inbound manager flow that we've received in the space over the last 24 months has been significant. So there's a lot of asset managers really trying to put products out there. What we have done, and part of this is a function of our governance structure and asset allocation setup, we don't have a target to a private credit. We're taking some liquidity risk and tying up capital, so we're placing that in our private equity portfolio or private real assets portfolio, kind of looking at the strategy as maybe as a barbell approach. So maybe we're a little risky on certain portions of that portfolio, and it's acting a little bit as a ballast. Historically, the types of strategies that we have found most compelling for us have been less I would say the traditional private credit to a corporation, maybe more some of the private specialty finance type strategies. So they're agricultural lending, where we're working with bankers that lost their jobs from Dodd-Frank and had to find a different source of capital to continue their strategies. Also, maybe some bridge loans to real estate companies that real estate development, just things that banks used to participate in, they no longer are. And And we view that as an attractive opportunity relative to the overall portfolio that we have in place. We've done a little bit of the more diversified private credit, but it's been more, for us, more sector specific as opposed to generalist. Part of that could be a function of being $800 million. We're a little bit smaller. We can get meaningful stakes in smaller funds, and that's really how we've approached it. So we're pulling back from some private equity and private real assets to invest in that, knowing that we've also been a little bit underweight traditional fixed income as well.